YouTube, what's going on? Welcome to Wealth Wednesday. It's good to see you. Let's make sure that everything is working the way that we know it should. All right, live and recording. YouTube, what's up? All right, let's get ourselves going here. So, IG, YouTube, welcome. So today we have a very special case study today. Today's case study is something that was in the market today recently. And what we want to do is kind of highlight certain opportunities for you guys to get access to how I do things from just a financial standpoint, just my methodology, how I go about doing it, and kind of give you some tools along the way. So for folks who are new, my name is Bernard Jigwe. I am a co-founder of The Way. The Way is a nonprofit that does financial literacy, relationships, and philanthropy. We have a podcast every week that talks about those three areas. So if this is your first time joining us, welcome to The Way. All right, so let's get started with, first and foremost, here's our website. Folks who don't know, you can click the link in my bio. That'll take you to the YouTube stream. You might need to do that today because we're going to be using the YouTube stream to show you some of the windows that we want to kind of walk through with this case study. So if you haven't done so yet, click the link in my bio. If you haven't added us as a channel on YouTube, definitely add us on a channel so you'll get updated to any of the new episodes that we have. And yeah, so we're going to be using both the YouTube kind of share screen function as well as just the IG platform to show you how to go about utilizing, looking at a stock, understanding its entire story, learning why things are the way that they are, and then kind of making a decision for yourself here or there, okay? All right, so let's get started. If you're on our YouTube feed right now, you'll see that this is our website. You can always catch our live streams directly on the website. If you click the play button on there, you'll be able to get access to that too. So that's just an easy way to get through. So about us, we do our podcast. This is myself and my wife, our founders. And also, we actually do have a section I want to bring out with you guys. It's the philanthropy opportunity. So on our website, you can literally donate to our nonprofit. The goal for these donations are to bring out our financial literacy program, which is for kids ages of 7 and 17, as well as adults. So we're actually offering the program right now to adults as well. So any donations that we get are going to be going towards building out our app and making sure that this is information that we can share with the world for free. That's the goal of our podcast. So hope you guys can take an opportunity to check out our website. And if you can, kindly donate something to us. Hey, what's going on? I'm Beb. How you doing? Mr. Brandon, what's going on, sir? Pleasure having you here, man. All right. So let's get into it. So I will start off with an image on IG. Oh, there's my daughter. So that's great. Let's get another image here. Okay, so let's do this one. Boom. All right. So if you guys are on our website, you can take a look at that. So HYRE is in a free fall after earnings disappointment. So this article here, why HYRE stock is plunging. Okay. I want to talk about this for a second. So this was dated August 11th at 8:05 a.m. Clark Schultz is the one that wrote this. It said HYRE NASDAQ symbol HYRE sinks in early trading after missing Q2 earnings per share and EBITDA estimates by a wide margin, despite posting 62% sales growth. The company saw an adjusted EBITDA loss of $7.1 million for the quarter versus negative $2.0 million consensus. Some of the higher costs during the quarter were attributed to investments in marketing and sales by HYRE to drive higher top of the funnel volume. So basically, the reason why they fell off was because they were looking at growth opportunities, right? Now, it's important that you understand that looking at a stock is more than just seeing if the price goes up and down, okay? You have to kind of know why it did it, right? So on this article, it talks about the fact that it dropped, and let's look at the chart. So for all of those who are on our YouTube channel, we're going to go over to the chart, and let's take a look at what happened, all right? I love charting this because when you chart these things, you can kind of see all of the points that you want to see, right? So I'm going to go back a month. All right. Check that out. So a month ago, HYRE was trading on what day is this? This is, scroll down a little bit further. Okay, this is 8/9. So August 9th, HYRE was having a positive day. It opened at $18, closed at $19.49. And then after that, it took a dive on August 11th. Is that August 11th? Yep. The price opened at $13. So literally overnight. So from the 10th to the 11th. So from the 10th, when you went to bed, your stock price was $19. When you woke up the next morning, it was 13. Okay. Now, I actually experienced that loss. And this is why I tell you guys, you cannot look at investments and be afraid of losses. It's going to happen. Don't be afraid of them, right? So I went into this stock and I had in shares of this stock. I think I bought in at like $17, $18. And the stock price literally overnight drops to, what's that, 13? What's the number here? Drops to $11, right? Low at $9 and opened at 13 and dropped down to $9, okay? And then from there, over the 12th, 13th, 14th, 15th, it continued to drop. Now, on the 20th, and the 20th was, what was that? Was that the Friday? I think that was the Friday. Let me just make sure I have my dates correct. Can someone tell me what day the 20th was? Let me make sure that that's the right day. So I think that was Friday, right? Okay, well, if it wasn't, well, just bear with me here. I don't have a calendar in front of me. But this past Friday, I had seen the stock drop again. And I was like, you know what? If the stocks keeps dropping like this, there's got to be a rebound, because now the chart is getting to a place where now it's oversold. If you're on our YouTube channel, you're going to see the RSI, right? This is what I keep talking about when it comes to these stocks. So the RSI on 8/11 was moving at a 55, 57. So it was going 53. It peaked at 57. Then it dropped back down to 55. And then between the 10th and the 11th, the RSI dropped, which is the relative strength index, down to 27, which is where it stayed. When an RSI is below 50, that means that it is oversold, which means that people have sold the stock too hard, and now it's at a discount. It's at a value. Consider it like, let's say you had a car, and your car is typically worth 20 grand. Because of pandemic, no one's buying cars. They dropped the price from 20 grand down to 10,000. But it's a car that you wanted the entire time, right? So you would look at that as an opportunity to buy that car at half price, which is exactly what HYRE stock was. Ticker symbol HYRE. Now, the problem is when you already owned the car and you were trying to sell the car, and then the value does this, where it drops by half. So now, if you sell it now, you're going to get half your money. Never, 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 never sell your stocks off of emotional drops. Don't do it. Don't sell your stock whenever something like this happens, especially if you know that the company is not going bankrupt. It's going to be around. This is your opportunity to make more money. Okay? Now, let me show you how. So, looking at the chart, the relative strength index dropped, right? From the 10th to the 11th and that's a Friday. That dropped down to 27. Okay? That is a time where you know that if you buy shares of this stock, you're getting them all at a discount, because the relative strength is below 50. Anything below 50 means you're getting a discount on the stock. Anything above 50 means you're paying a premium for it. Just how it works, right? The RSI. So from the 11th all the way to the 20th, okay, it's 9 days. For that 9-day span, the stock price fluctuated between $9 and $10, $9 and $10, $9, went down as low as $9.23, $8.89. What day was that? The 17th. And it continued to do that. And the lowest went down was to $8.50. Actually, $8.29 is the lowest. So $8.29 was actually the lowest. All right, and that was on, what day was that? $8.29. Okay, so $8.89 seems to be the lowest. $8.50 was the lowest. So the lowest the stock went was $8.50 on August 20th. Okay? Now, at that point, on August 20th, the RSI was at 26.99, so still a discount. That's when I saw the stock, because I don't look at my stocks every day. I don't need to. I have a stocks app. I could look at it, but I've picked stocks that are going to be long-term winners, right? And there's a reason why I picked them, because I see the model that they have. I see their opportunity for growth. There are reasons why. So once I pick you as a stock, chances I'm going to keep you long-term. So when I noticed that the stock had dropped to its lowest point last Friday, I put up on the IG and I said, listen, guys, this is going to pop on Monday. Automatic. Like, it was simple for me, because I know how this stuff works, right? And for me, when I see the RSI, when I looked at the stock and I actually looked at it, I saw the RSI as low as it was. I saw what happened at the lowest point. I'm like, okay, at this point now, this is going to pop. So I put it on IG. And if you guys bought on Monday like I did, I was guaranteeing that you would get at least 10 to 20% on Monday, right? The reason why I could guarantee that is because something called a retracement. A retracement happens whenever a stock drops by 50% or more. There is a retracement that you can follow to see how strong the rebound is going to be for that stock. Now, before we get into retracement, let's talk about like logic, right? And just like mindset. So HYRE, the reason why I invested in them in the first place was because they are a company that allows owners of vehicles to rent out their vehicles to people. That's their business model. So let's go to so I'm on yahoofinance.com for folks who are listening on IG. Just go to finance.yahoo.com and click in the ticker symbol HYRE. You'll get to their actual summary page. I typically go to the profile. Whenever I start looking to invest in a stock, the first thing I do, I go to the profile and I read up on what the stock is, right? So this company, I'll read it to you. The description: HYRE Inc., together with subsidiaries, operates a web-based car sharing marketplace in the United States. Its marketplace allows car owners to rent their idle cars to ride-sharing service drivers, such as Uber and Lyft drivers. HYRE Inc. was incorporated in 2014 and is headquartered in Los Angeles, California. Okay, so their business model is essentially folks who have extra cars. They are giving people access to those vehicles to rent them out, to do Uber Eats, Uber, Lyft, those types of things, right? That is a market that is wide open. Okay, so for that, I like the idea that, you're using a web-based service to do this. The second thing is, the reason why I like them as an investment is that they're small and they're growing. They're growing their market share right now. Their competition is Avis, all of those other kind of rental car companies, but they don't have the overhead. So for me, I just saw that as a very good reason to invest in a company like this, where, they're not concerned about all of the overhead that other car renting companies are concerned with. It's not even their assets. So they're just insuring the vehicles and that's about it. If something happens, the rideshare insurance picks it up. So they had a good business model for me. So I understood before I even invested in this company that the model looked successful, right? They're kind of like the Amazon of rideshare, essentially, right? They're giving people like buyers and sellers a platform to kind of come together, and they just make money on the overhead, right? So it's a beautiful thing. Now, because I know that, when I invested in them, I knew that there'll be more opportunities to invest more money with them. So I bought in like around $18, $19. The stock kind of fluctuated a little bit, then it dropped by half. Okay, so now we're here. My stock portfolio that has HYRE stock is halved, right? I bought the exact amount of shares that I owned. I purchased that many shares at the bottom on Monday morning at 9:30 a.m. The reason why I did that was because I believed that the stock price was artificially moved due to a report, right? And that if I read into the report a little bit more, I would know why it happened. So we're going to give you those tools right now. So let's go into the report. So the stock plunges, right? This is from the Motley Fool article written by Neha Chamaria. HYRE costs though remain high, but management has big growth plans. So what happened? HYRE are falling off the cliff this morning, down 46%. Demand and revenues were growing faster than expected, but so are HYRE's losses, and that's something the market analysts didn't like to see. So what? HYRE started off as a car-sharing marketplace that spotted an opportunity within a huge addressable market of ride-hailing service providers, Uber and Lyft. Individuals who rent their cars on HYRE's platform can use them to make money driving Uber and Lyft. Now, the reason why HYRE didn't have the revenue numbers that they were supposed to have is in this article. HYRE wanted to expand their infrastructure because their revenue was outpacing their actual opportunity, like their actual hardwired like data centers. Like they didn't have enough bandwidth to handle the demand that they got. So they now, so what they did was the money that they had made between last year and this year, the stock had moved a lot. So last year, this stock price was, and again, we're doing our case study on this right now. So I know there are other companies that we can talk about, but I want to kind of break down one. That way you can see the logic and why we do it this way. Last year, HYRE stock price was, let me go to the dates so I can see the date here. So last June, that's August, HYRE's sticker price was $3.60. Okay, $3.60. That was on August 7th of 2020. Okay, so from August 7th of 2020 up until even recently, August the 10th, right? The price went from $3.60 up to $18 or $19. So when a stock price does that, the company actually gets the money. Like they actually have that money now in their accounts because whatever they had that was valued at $3 is now 6 times more, right? Cool. So they have the money now in their accounts that they can now use to grow their infrastructure so that they can actually manage more vehicles, manage more owners, manage more bandwidth. So they invested money in marketing, in infrastructure, in hiring employees to kind of manage the growth demand that they expect. When a stock drops for that reason, that should be an incentive for anybody to think like, hey, I should jump on this now. Because not only do I have an opportunity to get in at a really decent price, but I know that the company is reinvesting its revenue into itself in a manner of which is going to allow it to grow. When you remember micro and macroeconomics, when we talk about economies of scale, where you might have a company that's doing 10 utils every month, and then for them to go from 10 utils to 100 utils, they got to have an economies of scale increase where they have to either increase factory, increase inventory, increase staff, increase a lot of things in order to get them from this level to this level. And then they can plateau as they go there, and then they go do it again. Economies of scale grows like this. Companies do this. So whenever they're meeting a point where they're at a threshold where they can no longer service the amount of demand, they have to then do an upgrade, and they have to raise their economies of scale to another level, which requires capital investment and recapitalization. You have to put money back into the stock, put money back into the company. So when companies are doing that with their money, that is a very good thing. That is not something to be afraid of, right? And remember, the platform is only going to have positive things, in my opinion, because again, they're going to probably partner with these rideshare companies. Like there's going to be a contract of some kind at some point in the future. Like right now, they're just using it for these purposes, but they're going to have a formal agreement at some point. And whenever that happens, the stock is going to bump again. So because I'm looking at this as a long-term play, because I see that the company is actually doing right with their actual cash on hand by reinvesting it in ways that can make them more money, I'm comfortable putting the amount of shares that I had, doubling it at that $9 mark, because I'm like, there's no way that this is going to turn out negatively for me. I'm investing long term anyway. Why not put more money in? So we did that. Now, since then, the stock price has gone from $8 and what was it? $8 and change, $8.75 up to $11, right? So about that dollar half is about maybe 15-20%, right? Seems like a little bit, but again, there's more room to run with this. As they continue to make better decisions and as they continue to increase their supply chain and increase their ability to accommodate the volume that they're going to be getting, as the economies open back up, hopefully the Delta variant does not continue to decimate us, they're going to make a killing because their business model has very little expense and only revenue that they can generate, right? So to me, it just seems like a win-win. Now, we're going to go into the articles real quick because I want you to see why, companies like this, you have to kind of follow them. So they announced their second quarter financial results. Let's see. Their second quarter revenue increased 62% to 9.1 million as rental days exceeded 333,000, up 44% year over year. So as of their second quarter, HYRE was seeing a huge increase in the demand for their services, right? That's the kind of numbers that you want to see. Their revenue was 9.1 million compared to 5.6 million last year. Their net loss, earnings per share, I don't need to read that. I don't care about that. I care about the revenue. So when a company is starting up, just so that you know what I'm looking at, right? I don't really focus too much on their expenses as I do as much as their revenue, Because if the revenue numbers are going down, the company is not really going to be as viable, right? As long as the revenue numbers are going up and significantly up, the company now has opportunity to do a lot of like growth, you know? And again, a startup usually has a lot of expenses. That's something that, you know, is part of the risk if you want to invest in a startup company. You know, you're going to have to be comfortable with knowing that it may not, you know, show great numbers in the beginning, but you just have to stick with it, you know, knowing that it's going to continue to do what it's supposed to do. And it's going to be good eventually, right? So let's make my screen a little bit bigger here. All right. So second quarter highlights, new drivers on the platform. So this is quarter two. So quarter two is ranged from March to June, right? They had new drivers to the platform in the second quarter. It was up 49% year over year. Number of days rented went up by 44%. Commercial bookings represented 75% of all their cars rented. So basically commercial organizations are doing more of the renting than other things, which could be like for, you know, different events. You know, commercial could be businesses renting out those cars. It could be a service sort of like, you know, some sort of bed and breakfast now renting, having vehicles available to be driven if you come into their bed and breakfast. So, you know, if 75% of their customers are businesses, that's a good thing because businesses have less volatility than customers, personal customers. So you're already in the right market fill there. It says that HYRE second quarter revenues grew 9.1 million, showing the resilience of their platform and growing demands for their services as the country opens up. In addition, recently secured millions of dollars of financing for their fleet partners, solidifies their ecosystem to help drivers and fleets participate in the transportation and service industry through partnerships with some of the largest players in the gigs ecosystem, and laying the groundwork for adding vehicles and drivers at scale over the next 18 months. So in this quarter two article, they're basically saying that they see themselves being able to really rapidly scale up, which is that economies of scale thing, move momentously over the next 18 months, which is a year and a half. Okay. So if you're making this move and you're thinking the way that I'm thinking, you're in this move for a year and a half. So no matter what happens from this point forward, going forward, if the stock drops again, if it's moving with the sales cycle, with the movement cycles, if all that stuff's happening, I'm okay with that because again, they have an 18-month, that's their time frame for them to jump from this economies of scale to this one based on the infrastructure movements that they've made. That is what you have to bank on. That is the expectation. So if you're going to invest in this long term, if you're going to follow what I'm doing, well then, you know, pony up, buttercup, right? This is the time to get in. Because again, you know, even if the price falls a little bit more, the goal is anytime the stock price drops, you buy more shares because you're getting a discount for a company that's going to be around. And if these guys partner with Lyft and with Uber the way that they're saying they should, this price is going to go up no matter what. It's automatic because now they're getting access to more drivers and more consistency. Because if you have Lyft and Uber drivers that want to now rent your cars consistently, that's going to increase the amount of time that they have rentals out. That's going to increase the money that the owners of the cars are making, which means HYRE Cars platform is getting more money. As long as cars are being rented on that platform for longer periods of time, they make money without having to buy any vehicles. It's a brain savvy business model. I mean, God bless them for that one. Let me just say hi to the folks. Hey, Fee, what's up? Victoria, what's going on? Shauna, what up? What up? JB, what's going on, brother? What's going on, Auntie? All right. Reboot NYC. What's going on, my man? We're talking some stocks. We're talking HYRE stock symbol right now. We're doing a case study on them. So just kind of giving folks the tea on that. Did I pin this? Pin comment. There we go. Okay, what's going on, Tasha Jones? How are you? Servino, Steve, what's up? All right. Okay, JB, hang out with me, man. We got you. So, all right. So right now, okay. So again, the reason why this company is moving the way it's moving is because they are trying to scale up. Anytime you go from $3 last year in August to $19, you did some good stuff, right? And now you want to go from 19 to possibly 60. In order to get that move of 3 times, you got to invest in your infrastructure. And I've used HYRE Car before as an owner. Right? I have multiple vehicles here, and I've actually rented out my vehicles a few times with them. And I've seen their service. They don't have enough call center representatives. They don't have enough bandwidth on their website. They don't have an app. So they're still in the process of developing all of these things. Like their app is only for drivers, not for owners. So they are still developing their business model, which makes it the perfect time to invest in a company. Because when you invest in a company as it's already blossomed, you've missed out on growth opportunities. Now look at the example, right? A year ago, this stock was $3. That was when it was growing. It was still relatively new, but its model was intact, right? That's when you invest. And if you got in, you 6 times your money in a year. Now, could that potentially happen again in an economy like this where COVID is kind of doing its thing? It's likely that it won't be that level of 6 times. I'm not predicting that, but to see it go 3 times from where it is right now, from $9, $10 to 33, that's extremely reasonable. That's extremely reasonable. And I don't think that in an 18-month span that is outside of the realm of possibility for them. Their platform's already oversaturated. Their owners can't even get access to call center folks in time. Like, there is a need for them to invest in their infrastructure. So they're doing that now, which is a good thing, right? So because of that, I am bullish on them. Now, let me tell you why it's important for you to know what you know before you get into this game. So if I go to Yahoo Finance, which I always do, and I go to summary, Yahoo Finance has a performance outlook feature where they show you what the performance outlook is for a stock. Now, it says that HYRE's short-term outlook is a negative, red. It says its middle term, 6 weeks to 9 months, is a negative. And it says its long-term outlook, 9+ months, is also a negative, right? This is a good indicator for companies that are well-established, that maybe they're not the right company to invest in right now, okay? But for a startup, I want you to know this. When a company is a startup or it's in a startup phase, right? This does not scare me one bit. This doesn't even faze me one bit. Why? Because I understand the model. I understand what they spent money on, which is why their ratios look crazy, because they're now spending more money than they should, but they're doing it to build economies of scale. So I'm okay with that type of spending. It's sort of like when you look at someone's credit report and all that's on there is student loans and a mortgage, right? I'm good with that because that's good debt. You can get the interest off those, the tax fees. Those are obviously education investing in your mind. Your mortgage is investing in a home. Like, you're investing your money into something that is useful, right? As opposed to if on your credit report, all you had was credit card debts, loans for lending loans, owing the guy that bought your furniture. Everything you have is a loan or a credit card. If that's all you got and they're all maxed out, what you're spending your money on is trash. So I'm not going to really trust your credit worthiness, right? Similar to companies, when they are spending their money in wise ways, like getting more education doing college or getting a house. In business term, it's investing in infrastructure, hiring personnel, hiring, whatever they need in order to build out their industry. When they're doing that and they spend the money, what happens on their balance sheet is their balance sheet looks a little crazy, right? Their balance sheet looks like they're spending more than they have. So because of that, investors are afraid because they're saying, okay, you had $9.6 million and you decided to go spend $20 million on infrastructure. You only had 9. Why would you spend an additional 11 million that you didn't have? Okay. Are you expecting to make 30 million? Are you expecting to make 40 million next year? Like, what are you expecting in order for you to convince yourself to spend that much money on infrastructure, right? That's how you have to think. When companies are doing that and they're seeing that their ride demand is greater than their capacity, they have to spend money in order to increase their capacity. It's something that you learn in macroeconomics, something you learn in your MBA programs. If you want to sell more units, you've got to either hire more staff, increase the size of your factory, increase the machinery in your factory to produce more utils. Like, you have to increase things in order to get the amount of revenue that you're looking to get long term. That's what they did. So even though their balance sheet looks crazy now because they have these huge loans on infrastructure, these huge loans on, spending their money on these, economies of scale type of growth, machinery, technology, employees, what have you, because their balance sheet looks negatives, that shouldn't scare you, but it scares them on Yahoo Finance. It scares the performance outlook because they're saying you spent a lot of money. We don't trust your balance sheet anymore, so we're not going to tell people that you're a good buy. I'm letting you know right now, in my personal opinion, this is not only a good buy, but it's a no-brainer because you're looking at a company's model, you're looking at the partners that they have, you're looking at their increase in revenue year over year, looking at their stock price from $3 to even right now it's $9. So what? If you had a stock a year ago, you tripled your money. So looking at even the worst case scenario, they're primed to do something good. As long as the economy doesn't crush their hopes and dreams, they're in a good position right now. Okay, so this performance outlook piece that I just showed you here, I just want you to know that don't be afraid of that. Don't let that deter you from investing in other companies, because again, like I said, it's not a perfect science, but with a startup, it's really not a perfect science, because startups don't follow the same track as an established company. If that was what they said for Tesla, let's look at Tesla right now real quick while I have you guys here. If the performance outlook for Tesla was that way, let's look at it. So for Tesla, which is an established company, right? Their short-term outlook is a negative. Their middle-term outlook, which is 6 weeks to 9 months, is a positive, and their long-term outlook, 9+ years, is 9+ months, is a positive, right? With well-established companies, if I see negatives across the board here, I'm pulling out, because they know something that is actually important. Because again, these companies are established; they've been running for quite some time, for maybe 5, 10, 15 years. If that is a negative, then they're using data to do that. They're using data to determine this company is not doing right by its shareholders, right? So I'm going to listen to that. However, when it's a startup, no one knows what the company is going to do yet, because the company hasn't done it. All the numbers that they're using is numbers that are going to be kind of messed up, because they're investing in themselves. They're investing in infrastructure. When that's happening, your numbers are always going to look bad. That's just a part of starting up. If you haven't started a business, you know that in the first 2 years, you don't even break even. Any entrepreneur that knows their business knows that in the first 2 years, you're just struggling to break even. From the 2-year to 5-year mark is where you're going to actually make your establish yourself. And at the 5-year mark, economies of scale happens. That's when you have to either franchise out, buy a bigger building. That's how most startups work. So I don't trust that performance outlook for a startup, but I do trust it for an established company. Okay, so let's go back. Now, I want you to look at this article here. If you're on our YouTube, again, like I said, click the link in my bio. The YouTube is where everything's at right now. We're showing articles. We're going through. Looking forward to learning more about stocks. Yeah, Victoria, trust me. Like, you hang out with us, you'll learn about stocks every week. We're going to throw this up. Shanti Lou, what's up? How you doing? Capitaled? What's going on? How you doing? Nice to see you. All right, so this is an article that's written in July. Can you imagine how elated HYRE shareholders feel about the 434 share price gain? So again, this is after Q2, right? Do you see? Articles can help your stock go up. They can help your stock go down. Don't necessarily emotionally move with them, right? You need to know that no matter what the article says, you have to be in it for the right reasons. You have to understand the company's business model. And yes, if you do it right, you can make a killing. If you do it wrong, you're just gonna have more opportunity to buy more stock at a lower price, or you're gonna be bankrupt. So there's opportunities for both ways to swing. However, on this article, this was written in July 24th. It says HYRE Group's revenue by 48% last year. That's well above most other pre-profit companies, but the share price has really rocketed in response to gaining 434%, as previously mentioned. Even the most bullish shareholders might be thinking that the share price might drop back a bit after a gain like that. But if the share price does moderate a bit, there might be an opportunity for high growth investors. This was back in July, they said this, right? You can see how earnings and revenues have changed over time in that image below. On the image, it just shows HYRE's earnings, and it just shows the revenue going significantly up after 2020. From 2019 to 2020, it was a steady increase. Their expenses are moving as well. Their free cash flow, revenue, earnings, free cash flow, and cash from operations. So these are all, again, cash flow is going down. Cash from operations is going down because they're buying and investing into their infrastructure. However, they're doing it because their revenue is steadily increasing. And in order for them to do economies of scale, they need to increase their ability to have these customers. The chart looks like it goes up about 5 times between now and 2024. So right now on this same chart that I'm looking at, if you guys are on our YouTube, you can see this. The chart's graph is showing what it did up until 2021. And it's showing its projections going into 2022, 2023. And if I can estimate this chart for you, it basically looks like the chart is growing by 4 times from where it is right now on its revenue side. So they're saying in the next 4 years, they're going to have 4 times their revenue, which means that their stock price could potentially be 4 times higher than it is right now. Got to read charts. When you read charts, you know what's going on. We're pleased to report the CEO has remunerated the most modestly that the CEO of similarly capitalized companies. CEO is always worth checking. Really important question. I don't care about all that. I want to know more about the risks. So they have 3 warning signs. We will like HYRE better if we see some big insiders buy. While we wait, check out this free list of growing companies, blah, blah, blah. Okay, they're selling me on crap. And they didn't tell me what the 3 things that they were warning signs. Let me click on this link. There are 3 warning signs. Currently unprofitable and not forecast to become profitable over the next 3 years. Significant insider selling over the past 3 months. Shareholders have been diluted in the past year. That's their risk. Their revenue, however, is forecasted to grow 58% per year. So when I look at the rewards versus the risk, right? They're saying that the executive summary is that the reward, the revenue is going to grow by 52.8% year over year. However, it's a volatile stock and it's not forecasted to be profitable in the next 3 years. Those are contradictory points, which is why, again, like I said, you cannot always look at these executive briefs and see the truth. The truth of any company is if you're making a revenue increase of 52% a year, you're not going bankrupt anytime soon. I don't care how you're spending. If you're increasing by 52%, you're basically doubling your revenue every year, essentially, right? Or getting 50% revenue every year. Like if you're doing that, how are you going bankrupt? There's a demand for your product. There's a demand for your service. That's a great thing. So I will take the risk for something that's doing that. Not a lot of companies that you know are going to be revenue forecasting 52% gains every year. How many companies are doing that? Not many. So share price events. Oh, I have to join their membership. Do you see how they did that? This is what finance companies do. So instead of you being able to like see their stuff, they're like, oh no, you're going to have to join our membership now. So this is why we're doing financial literacy for free on here, because every time you try to like improve your knowledge skill, someone's trying to take money out of your pockets. Okay, ready to recover kits. We don't need that. Okay, so I will close this finance tab now because I think I've shared that with you now. So I can just close this out and we can just talk. Okay. YouTube, sorry, we're talking. All right. So what do y'all think about that stock? I know there's some of you in the room right now and folks who are going to watch this after the fact. We do have a lot of folks that are going to be reviewing these types of videos after the fact. You can just, put your comments on below underneath the chat. But the question I have for you is, do you think that this is a good time to buy HYRE stock? Yes or no? And why? Do you agree with me that a company that was at $19, but that shrunk to $9 has a potential for growth if it's investing in itself? And that's the reason why the price dropped? Yes or no? And going forward, do you think that their projections, they're saying that they're going to be a 52% gain every year, that those projections are good enough for you to then say, let me invest some money into this, all right? Those are the 3 questions I have for you. And I want you to tell me what you think. So folks who are in the chat, you can tell me what you think. Folks that are on YouTube, you can let me know what you think. But in my personal opinion, I see them as a long-term purchase. They're going to continue to expand their market share. And if there's no competition, there's really nothing to stop them. So I am bullish on them. And I think that they're going to be a company that for the long run is going to make a dent in rideshare, especially if they partner up with Uber and Lyft and they have a contract going forward with them. That's going to make the biggest difference. So from now, we're freestyling, y'all. What questions do you guys have? You guys have any stocks you want us to look up or any things you want to discuss? If so, this is your time. We are done with the content. So no questions? Okay. So I will freestyle. Let's see. Okay. So let's talk about your current plan right now for yourself, right? There are a lot of opportunities for, Motor Group. Yes, sir. Yeah. I mean, long term, man, if they're projecting 52% gains every year, it's hard to find that anywhere. So to me, it's like for the risk of $10, I mean, you could buy McDonald's. That's the Big Mac #1 combo is about $9.99 plus taxes, like about $11. You can buy a share of stock that can grow to $30. Like we spend money on all kinds of stuff. So why not spend money on something that has a potential to grow, right? And I think rideshare is actually a pretty cool thing because a lot of folks, during the pandemic, they don't really want to take public transportation like that. So being able to jump in a Lyft or an Uber or to even rent out a car, it's going to be a thing. And if Uber does acquire Lyft, I think it might be the other way around. I think Lyft might acquire Uber. Which company is bigger? I don't even know which company is bigger. Let's see. Let me Google that. Let's see who's bigger company, Uber or Lyft. Google, which company is bigger, Uber or, okay, someone asked this question before. By most measures, Uber is much bigger and has more diverse revenue streams. It is the world's biggest rideshare company with operating in 63 countries. Comparison, Lyft operates in the United States and Canada and generates almost all of its revenue from its ride-hailing services. Okay, so check this, right? So Uber is bigger than Lyft because of their global operations, right? But I don't care about that in America. I don't care about that in Canada. If Lyft operates in the United States and Canada and generates almost all of its revenue from its ride-hailing services, I feel like over here the competition is going to be neck and neck. So I don't think Uber can buy them out. I don't think they can. Now that Lyft publicly traded and Uber initial public offering is approaching, they're also going to become competing for stock investors. Yeah, by most measures, Uber's much bigger than Lyft and has a diverse revenue stream. So they're basically saying that Uber, okay, so Uber's way bigger by bookings. Lyft includes taxes, tolls, and tips. Uber excludes tips. Uber bookings include what is charged for its food delivery. Okay, so Uber just has more ways of making money versus Lyft. And Lyft is smaller in comparison to their rideshare revenue. I'll show you what I'm looking at since you guys are here with me. Let me just pull this screen up so you can see what I'm looking at. This is the Uber chart. They're talking about earnings and losses. Both companies are racking up big losses in the case Lyft's faster pace is not a good thing. Lyft reported a loss of $911 million last year, up from $688 million in 2017. Uber earned $997 million last year, much better than its $4 billion loss. Wow, in 2017, but that's profit. But that profit included income from the sale of some assets. After backing out of those one-time items, Uber lost $1.8 billion last year. So both of these companies are losing money hand over fist. They're both pretty, they're getting smoked because of, again, the pandemic, right? That's really affecting them. Costs and expenses. So in billions, Uber's got a lot more, and they got a lot more bills. So Lyft might be expanding its revenue faster than Uber, but it's also increasing its spending at a rapid clip to catch up to its competitor. Lyft's total cost and expenses were $3.1 billion in 2018, up 77% from $1.8 billion in 2017. Uber topped $14 billion last year, 19% increase in expenses. So we're talking about in relative billions. So both of these companies are getting scammed right now. I don't think anyone can buy that. Uber doesn't have the money to buy Lyft right now. They're both broke on different levels. And that's a perfect idea of economies of scale, right? Uber is a much bigger organization than Lyft, and they're a lot more broke than Lyft. Like when it comes to their losses, the bigger you go, either the more revenue you make or the more losses you have. That's just how it works. Economies of scale works very uniquely. But this is, and I think this is why it's really cool to see where HYRE is right now, because if HYRE partners with these two companies, right, they're going to be able to increase the amount of drivers coming towards Uber and Lyft. If they can do that, well, then they're going to boost Uber and Lyft's revenue stream. So it's like a synergy that could happen. And if it does, and you were in HYRE before that merger happens or that agreement happens, you're going to be well positioned to make a killing. Let's see what Uber stock has done. Uber Technologies. Is this them? Let's look at their profile. Yep, it's them. Yeah, they have all their Uber caps. So yeah, this is Uber. So Uber Tech. Let's look at their chart. They're trading for $41 right now, $41.55 a share. And let's see if Lyft is. Lyft Inc. So Uber's trading at $41. Lyft is trading at $49. So I'm just looking at okay, so we're going to do a case study of another company. We're going to do a case study of Lyft and Uber right now real quick. Look at this. Let's look at the 6-month chart. Let's do 1 year. Okay, 1 year. So Lyft a year ago was trading at $39. It went up to as high as 64, dropped back down to about $50, right? So 39 to 50. That's not bad. That went up over the past year, which is not bad. Let's see Uber over the same duration of time. Summary. 1 year. Uber was trading at $33 last August, and now they're at $41. So Lyft did better. Lyft did better year over year, right? Okay. And they're trading around the same. So out of these two companies, honestly, I understand Uber's diversification, which is cool, but I kind of like Lyft. Out of these two, if I had to be a betting man, because again, Lyft's marketplace is in the United States and Canada. Let me close that out. Why am I getting a call during our lives? What's happening? Who's calling me? How dare you? But yeah, Lyft is Uber is $41 a share. Lyft is what, 30? What is Lyft? Uber's 41 right now. Oh, and Lyft is Uber is 41 and Lyft is 49. I mean, it's kind of piece of a pod at this point, but I like Lyft better, just to be honest, because I like the fact that they're positioned in two economies that are big for rideshare, and especially with the pandemic hitting us here harder than everyone else, I feel like folks are going to be more open to taking rides from those services and even avoiding public transportation just because the pandemic and the variants. So this might be a thing. But again, the hire car piece is the piece that connects all of this together. If these three companies figure it out and they find a way to partner together, this could be, Tisha, Uber is bigger. Uber is bigger. And I don't think they would merge. I don't think that they would merge, even though they should. They're in the same industry, and that would like kind of solidify a lot of things for both of them. But I think having competition is a good thing. I feel like, folks are going to together kind of pull both of them with the rising tide of needing their services. So it's a thing. As long as Lyft doesn't go into doing like Lyft drops, then, they're going to pretty much be outpaced by Uber every single step of the way because Uber is delivering services, right? So we'll see what happens next. But yeah, so that's pretty cool. And again, this is the outlook. The outlook for Lyft is short-term is a negative, midterm is negative, and long-term is negative, right? So again, these are the indicators that Yahoo Finance has for them, even though right now they have a bullish chart pattern, right? Over the last, 5 days, they've gone from 44 to $49. So, they're moving. They're moving. But yeah, so that's pretty cool. All right, what else, y'all? What else? What can we talk about that would be of interest to you guys? Have we talked about crypto lately? Let's go to crypto. Let's see what the crypto markets are doing. Cryptocurrencies. Let's see what we're doing here. Bitcoin is back. Bitcoin is back to 49,000. Who predicted that? Who saw that happening? Let's go to year to date. Now, y'all, do you see these charts? I don't make this stuff up, man. Y'all got to look at the charts. If no one's ever taught you to read a chart, go find someone to teach you to read a chart, because you're going to miss out on all kinds of stuff if you don't know how to read a chart. Look at this. Remember we talked about the RSI going into these things? Check it out. So Bitcoin, we're going back January of this year. They were trading at 36,000. They started at 32,000. Cool. RSI was way over 50. Okay. RSI was at 64. Where is this? 64, 57. It started going down, right? Going into January, end of January. Then it boosted back up again. Okay, cool. So let's go to when the market tanked for Bitcoin. That was 5/9. Okay. So May 9th, there was trading at 58,000. And then over the next week, it dropped down to $35,000. RSI was at a 27. Okay. You guys have to see this. When the relative strength index, which is an indicator, shows below 50, that means that buying those stocks or buying whatever that asset is at that time, you're getting it at a discount. It's the same situation that we're in right now with HYRE. They're selling below a 50 right now. Cool. The RSI is below 50. You have to see these indicators. This is all these advisors are doing. They're just looking at the RSI and saying, okay, the stock is trading below its value. Cool. Let's buy some. So if you were smart and you started buying Bitcoin back in May, right? When the RSI was at 35, which is below 50, which is that's when you buy them, you would have seen an increase from that point from 35,000 literally to 49,000 today over the span of 2 months. 2 months. That thing went almost like by 40%. 2 months. I don't care what the news cycle said. And this is why when you invest the way that we do it, you're not caring about articles. You're caring about what the actual numbers are saying. The RSI is a relative strength index. And back in May, it was at a 23. It was at a 24, a 32, a 36, went back down to 33, went up to a 46. Okay, that was when okay, we're seeing some movement. I would be buying this entire time. Buy, 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 buy. When the RSI dropped down to 32 back in July 20th, 2021, that is the moment before the RSI took off. The RSI was a 36 or 32, and it went up to as high as a 69 and a 70 July 29th. That should have been the first indicator that you should have known. Okay, this thing is moving, right? When you see RSI go from 30 and it starts moving up, that's when you should start buying. Just literally jump on the wave and start buying because that stock is about to fly, especially something like Bitcoin, where you understand that it's going through ebbs and flows because, again, the institutional investors that are in it, right? And from July 19th, Bitcoin was trading at 30,000 to right now, it's trading at 50,000, 40% gain in under a month. Did you see that coming? Do you think it still has more room to grow? Well, let's look at it. Right now, the RSI is at 65, 66. So right now, the stock is overbought, right? Which just means that you're not getting a premium right now. So we have a strategy for this. Whenever you are in a premium, only contribute whatever it is was your standard contribution. So like your 401k, for example, let's say at work, you've decided to invest 5% in your 401k, right? When the RSI is above 50, continue to invest as usual. The same threshold that you would normally put in every 2 weeks, that's all you do, right? When the RSI drops below 50, you should increase your contributions to whatever your investment is. If it's a mutual fund, if it's a stock account, if it's an IRA, if it's a 401k, a Roth, whatever it is. When the RSI drops below 50%, and you know that this stock is a long-term stock, that is when you increase your contributions to it. Similar to what we're doing with HYRE right now. You know, HYRE stock went below. Let's see what their RSI is right now. Like literally, this is the exact same thing that we have to look at doing when it comes to these opportunities. So HYRE stock, we're going to go to chart. I'll show you the same thing, y'all. I'm going to show you the same thing. So right now, their RSI is trading at 24%. It's at 39%, at 40%. It's still below 50, right? This is when you buy these things. The same thing that Bitcoin did in July, where it was at a 23, at a 34, at a whatever. And if you bought it then and it grew to 40,000, you made that killing. That's what these companies are built to do when their RSI is below 50. Just an indicator. If you've never heard of it before, you've heard it now, okay? This is the time to buy. When you see it move, so the RSI for HYRE on 8/11, which is when the stock price plummeted, it dropped from a 55 down to a 29. Okay, so it went from 55 to 29, the RSI, the relative strength index. When that happens, the stock price falls. Okay, that is when you buy. It was down between 29, 28, 29, 27, 28, and then it started to move on 8/20. It stayed there, and on 8/21, that sucker went from 20, 27, up to 39 in 1 day, or in 3 days, sorry. And the stock price followed. So to me, those are the movements that you want. And if the RSI for this stock goes from 39 to 50 or 60, you've made back your entire money, right? If you had bought the stock at $19 to begin with, like I did. So that's the goal for this company. That's the goal for these things. You got to look at the chart. You have to read these charts. Set it up where you can put the indicator for the RSI, which is the relative strength index. Make sure that you can see that. And literally, once you have the right company, your only goal is to continue contributing to that company over every week, every 2 weeks, whatever your contribution time frame is. But if the RSI drops for any reason whatsoever down to below 30s or 20s, buy. That's my advice for you. Any questions, y'all? Tisha, I am checking finance.yahoo.com. If you want to click the link in my bio, you can head over to the YouTube and you'll see the screen that I'm using. And you'll actually, as a matter of fact, when you're done with this live, just click on the link in my bio and go to the YouTube feed. You will see all of this on there. You'll see the charts that we're looking at. You'll see exactly where the RSI indicator is. And, it's really easy to set it up. If you're over, okay, so YouTube right now, if you're on YouTube and you're looking at my screen, I'm going to actually main screen this whole thing. I'm going to raise it to the full screen. This is how you set up your RSI indicator, okay? You go to the indicators section up here, open it up, and it says moving average envelope, deviation, Bollinger Bands Rsi. See that right there? You click that. And then it says periods of 14, that's fine. Close, that's fine. It gives it the color that it wants. Overbought 80%, oversold 20%. Those are thresholds. When a company is over 80, that means that it's overbought. That means that too many people are buying it, which means the price could fall. When it's under 20 RSI, that means it's oversold, which means that it's at a premium, it's at a discount right now. So you can either get in low and watch it rise. So it shows you the colors that go with that. You save that, and then boom, your RSI meter is located right at the bottom of your chart, right here. See that? I have two now because I had one already before, and I created another one. So I can just delete one right now. But that's your RSI. That's how you get this indicator up. So folks, if you're not following me, go to the YouTube channel and check it out. You'll see exactly how to do it, but just go to Yahoo Finance, go to the charts, click on indicators. It opens up commonly used. You have moving average. You have Bollinger Bands. You have RSI. You have MACD. Click the RSI. It's going to give you a dropout of periods. Just do 14. Overbought, oversold. Just save all that and just go. And you'll have that indicator so that you can, and then you can check any stock and it'll show you the RSI for that stock. So you can actually see if this is a good time to buy it or a good time to sell it. It's best to sell a stock when the RSI is above an 80 because it's at a premium right now. So that's when you're gonna get the most money for it. If it's below a 20, that's your best time to buy. So RSI is on 100% scale, right? So it goes 100%. So anything 50 is middle of the road, and below it means that you're getting a discount. Above it means you're getting a premium. You're buying it at a premium. So if you want to buy at a discount and sell at a premium, you're my friend. If you do the opposite, you're not so smart. Okay. Don't buy stocks at a premium and then sell them at a discount. Right. That's like me buying HYRE at $19 and selling it when it dropped to $9. I've just lost $10. I lost half of my money. Why would I do that? Right. As opposed to being the guy that buys HYRE at $9 and then it grows to 33. That's the difference. Right. It's going to have big correction again. Yeah. Moto Group, it will. The corrections in HYRE are because it has a lot of institutional investors. Let me see if I can pull this up. We only have 1 minute. So I can pull this up real quick. Google HYRE institution ownership. So HYRE has a 71.35% institutional ownership, which means that institutions are buying their stock at 75% of their stock are bought by an institutional buyers. Understand that. That's why the volatility is there, because when an institution like a hedge fund or a large trust fund or whatever buys a bunch of these stocks and they want to sell a bunch of them in one day, it'll drop the price. Like they can fluctuate these prices even if they do any sort of arbitrage or options trading on it. When institutions own more of your shares than regular personal investors, you're setting yourself up for, a lot of volatility. But like I said, I don't care about the volatility. I don't. What I care about is the business model good? Are they setting up the right way? And if so, cancel. Look at it. I can't even get into it now because they want me to buy something. Can I get in at a time at a price point that's below on the RSI meter? And are they going to be around for the next 4 or 5 years? They are, right? So to me, this is what you want to see. You want to see companies that have the potential to just grow regardless of who buys them. So folks, that's Wealth Wednesday, y'all. Do you use time frames? Yeah, 12 or 14. What's your YouTube channel name? Nene, just click the link in my bio and you'll see it. It's The Way. It's got a little golden tree as our little symbol. So that's that. With the Fed meetings this week, I see big drop if Powell mentions tampering. Maybe he's taking on Friday. Pay attention in there. Yep, definitely. Yeah, every time the Fed does stuff, you got to remember things are going to move in the markets. But again, your strategy shouldn't be about what the Fed's going to say or not say. It's got to be about the fundamentals. And I told you, HYRE is a good, fundamentally sound business model. So unlike Uber and Lyft, they're not hemorrhaging money for no reason. They're hemorrhaging it to make themselves better. So with that being said, y'all, we got to go. Ran out of time. But thank you so much for joining us on our podcast. We appreciate you guys. So IG, I'm going to let y'all go first because technically you're going to kick me out anyway. So Mortal Group, I'll catch you, brother. I got to call you this week. I'm going to call you tomorrow, actually. I'm making that point. All right? All right, people. Take care, guys. We'll talk. All right. Later. No problem, Tisha. I got you. Later. All right, YouTube. So you guys hung out with us. Okay, yeah. Nisha, I'm glad you got it. I'm glad you got the information. Hey, Queen, what's up? Shelly, what's up? Yeah, no, this is what it's about. We're here to share that knowledge and make sure that you guys know what the hell you're doing. When this market does what it does, you can't fall victim to this stuff. You got to know what's going on. So with that being said, I'm going to stop the recording on this. So recording, adios. Thank you for joining us. Boom. So that recording's done. And I'm going to outro myself because I like music. I just can't, I don't like not having my music. So let me do my music real quick. I'm old school. I like what I like. That's how I am. gotta get the vibes out. Fred's my dude. So hopefully you guys found value. I'm glad that you're here to join me. This is what we do every Wednesday. We're here. We're gonna be giving you guys some gems. Today was a case study on HYRE. I wanted you guys to see how I break down this stuff because you gotta just know, and if you don't, you gotta see the process. And if you see the process, then maybe when you do it in your own time, you're going to be able to see things differently or you see opportunities to get into things that you never could get into before. So, folks. Oh, I got my little. Join in. This is The Way podcast. You know how we do it here, folks. We appreciate you all. Join us next time. Peace. Oh, man. That voiceover always gets me. I'm like, that guy sounds better than me. Why does he sound better than me? I thought that was me. But yeah, folks, appreciate you. Appreciate you guys for joining us. Thank you so much. And I will catch y'all offline. Share this channel with your friends. Share that if you saw any value. Go to our website. Kind of keep plugged in with us, and we're here for y'all. All right, so folks, peace, love, prosperity, and we will catch you guys next week. All right. This is Bernard signing off. Have a good night. Love each other. Love yourselves, and just know that their time's up. So it's our time now. All right, y'all. Peace out. Catch you guys on the other side. Later.